welcome to Credit Compass, your guide to navigating European credit markets. This week, we're looking at a Europe that continues to face no shortage of challenges, yet continues to demonstrate remarkable resilience. Wildfires are spreading across parts of the continent, energy prices have moved higher once again, geopolitical tensions remain elevated, and trade relationships are becoming increasingly complicated. Yet, beneath those headlines, important parts of the European economy continue to adapt and, in some cases, improve. Today, we'll explore what these developments mean not only for economic growth, but also for credit markets and investors. We'll examine the economic implications of this summer's wildfires, how rising petrol and diesel prices may actually be accelerating Europe's transition towards electric vehicles, and why the latest manufacturing data suggests the region may be weathering today's geopolitical uncertainty better than many expected. All right, let's get started. First, let's talk about Europe's climate challenge, which has become an increasingly important economic story. Wildfires continue to affect parts of Spain and France, with devastating consequences for the communities caught in their path. My heart goes out to everyone impacted by these events. In my home country of Canada, they are also experiencing another difficult wildfire season. Sadly, this is becoming a familiar story across much of the world rather than an isolated event. Here in the UK, we've also experienced an unusually prolonged, warm, dry spell. A rainless Britain? That really is something of an oxymoron. So, what does all of this mean for markets and credit? Well, for Europe, the immediate macroeconomic consequences remain relatively modest. The economic impact of wildfires is still small compared with the effects of energy shocks, financial crises, or even major flooding events. However, the trend is becoming increasingly important because fires are growing larger, occurring in more economically significant regions, and increasingly affecting infrastructure rather than remote forests. From a market's perspective, the key issue is not usually the direct destruction of forests or infrastructure. Instead, it's the disruption to tourism, agriculture, logistics, utilities, insurance, and government finances. My colleagues in KBRA's ratings teams have also been examining the potential implications for structured finance transactions and others. You can find their reports on our website, kbra.com. The economic significance of wildfires, though, is likely to increase over the coming decade because they increasingly coincide with heat waves, droughts, and water shortages. Rather than acting as isolated shocks, they're becoming a part of a broader climate-related drag on productivity. Repeated disruptions can reduce labor efficiency, raise insurance and financing costs, and divert public spending away from growth-enhancing investment. For Europe, the greatest macroeconomic risks remain concentrated in the Mediterranean economies, particularly Greece, Portugal, Spain, Italy, France, and Croatia, where tourism, agriculture, and water-intensive industries represent a larger share of GDP. Northern Europe is less exposed to direct fire damage, but is by no means immune, as drought-related transport disruptions, timber losses, and supply chain effects can still weigh on economic activity. For investors, the fires themselves are ultimately less consequential than their secondary effects. Higher food price inflation in select categories, increased sovereign spending, rising insurance costs, and a sustained cycle of investment in climate resilience. This makes wildfires an increasingly relevant structural theme when assessing utilities, insurers, infrastructure operators, and sovereign fiscal trajectories. For example, France's recent wildfire response adds incremental pressure to an already highly indebted public sector. The fiscal impact remains modest today, but it illustrates how climate-related spending could become a more persistent budgetary challenge over time. That brings us to another example of how Europe continues to adapt in the face of changing global conditions: the transition to electric vehicles. Despite growing political resistance in some markets and increasing trade tensions, the latest data from the European Automobile Manufacturers Association suggests that Europe's transition toward electrified vehicles has moved well beyond a purely regulatory story. It is increasingly becoming the primary engine of growth for the automotive market. New passenger car registrations across the EU increased by 5.7% year over year during the first half of 2026, with June proving particularly strong. Importantly, almost all of that growth came from battery electric vehicles, plug-in hybrids, and conventional hybrid electric vehicles, while registrations of petrol and diesel cars continued to decline. The decline in internal combustion engine vehicles has been equally striking. Petrol and diesel models now account for less than 30% of new registrations, down from nearly 38% a year earlier. This reflects changing consumer preferences alongside manufacturers' continued shift toward lower emission fleets ahead of tighter European emissions standards. While government incentives continue to support demand in several markets, the recent acceleration also appears to reflect improving model availability, falling battery costs, expanding charging infrastructure, and growing consumer confidence in electric vehicles. Higher petrol prices and diesel prices have only strengthened the economic case for EV ownership as operating costs remain comparatively low. From a broader macroeconomic perspective, the data reinforce the view that Europe's automotive sector is entering a new phase of structural transformation. Strong demand for electric and hybrid vehicles is likely to support investment across battery manufacturing, charging infrastructure, semiconductor production, and electricity networks, while continuing to place pressure on traditional internal combustion supply chains. At the same time, competition is intensifying. Chinese manufacturers continue to expand their automotive market share, increasing competitive pressure on incumbent European automakers, even as overall demand improves. EV adoption is an increasingly important indicator for industrial production, capital investment, and future earnings profile of Europe's automotive sector. That transformation also highlights one of Europe's biggest strategic challenges: its increasingly complex relationship with China. Trade tensions between Europe and China continue to rise up the political agenda within the European Commission, and the latest automotive data are unlikely to ease those concerns. As access to the U.S. market becomes more challenging, Chinese manufacturers are increasingly focusing on Europe, intensifying competition for domestic producers. A recent Bloomberg article highlighted German government efforts to map out the potential effects of a trade conflict on German companies while also identifying vulnerabilities within the Chinese economy. Europe has repeatedly raised concerns surrounding industrial subsidies and intellectual property protections. Understanding where both sides are most exposed will be an important part of any future negotiations. This is likely to remain a topic of interest for investors through the remainder of the year. Finally, despite these challenges, recent business surveys provide a more encouraging picture of the European economy. Last week, the preliminary July PMI results were published for the major European economies. They point to a noticeable improvement in economic momentum during July, although the recovery remains modest and uneven. The Eurozone composite PMI rose to nearly 52 from 50 in June, its strongest reading in 5 months and comfortably above expectations. The UK composite PMI similarly rebounded from 52.1 from 49.3, returning to expansion after 2 months of declining activity. Taken together, the surveys suggest that the weakness seen during the second quarter may be stabilizing and that both economies entering the third quarter with firmer underlying growth. Perhaps the most encouraging development was the improvement in manufacturing. The Eurozone manufacturing PMI increased to 52, while the manufacturing output index reached 53, its strongest level since early 2022. Germany was central to this recovery, with its composite index returning to expansion at 51.2, supported by a particularly strong increase in factory production. UK manufacturing also outperformed services, with its PMI rising to 52.8 and manufacturing output reaching a 22-month high. This suggests that Europe's industrial recovery is becoming more firmly established and may be benefiting from improving exports, inventory normalization, and stronger capital expenditure, rather than relying exclusively on consumer-facing services. However, the country and sector picture remains mixed. France continued to contract through its composite PMI improved sharply to 49.6 from 47.2, suggesting that the downturn is losing intensity rather than deepening. French services remained just below the expansion threshold, while manufacturing slipped back to a neutral reading of 50. Across Europe, new order growth remains less convincing than the headline output figures, and employment indicators remain relatively weak, particularly in the UK, where companies continued reducing staff despite improving activity. Businesses therefore remain cautious about treating the recent rebound as fully durable. Overall, the direction of travel appears to be improving, although the PMIs currently point to a shallow recovery rather than a strong acceleration. Softer input costs and selling prices pressures provide some support, while Germany's industrial improvement and France's stabilization should help broaden Eurozone growth over the coming months. Nevertheless, these surveys were largely collected before the latest rise in Middle East tensions and energy prices and subsequent collapse. Higher oil price and gas costs, renewed supply chain disruption, and continued uncertainty surrounding U.S. tariffs could weaken new orders and reverse some of the recent improvement in business confidence. Our central scenario, therefore, remains one of modest positive growth through the third quarter, but with the caveat that events in the Gulf provide a meaningful risk that July's rebound may prove temporary. Even so, Europe's economy continues to demonstrate resilience despite repeated geopolitical, climate, and energy-related shocks. Businesses appear, for now at least, to be working through the uncertainty rather than being overwhelmed by it. That resilience remains one of the defining themes for European markets today. Thank you. That wraps up this week's edition of Credit Compass. As always, you can find our latest research on macroeconomic developments in credit markets by visiting kbra.com/macrocredit. Thanks for listening. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass guide your way.